We often assume modern currencies fall because leaders mismanage budgets, but the truth runs far deeper. A hidden blueprint forged centuries ago silently shapes every currency's rise and inevitable collapse today. This blueprint began inside the Bank of England, creating a powerful, fragile financial architecture still dominant. Tonight we uncover why every major currency failure follows a template written in London long ago. The mystery begins in 1694, when England was broke, exhausted by war, and desperately seeking survival. The treasury was empty, gold reserves low, and traditional financing unable to sustain England's mounting obligations. A group of influential merchants proposed a radical solution that transformed global economic systems permanently. They offered a central bank capable of creating money not from metal, but government debt instruments instead. This innovation allowed England to finance wars, expand influence, and eventually dominate world trade powerfully. But it also created the first modern currency model dependent entirely on confidence rather than physical reserves. With debt-backed money circulating widely, England engineered a system capable of enormous expansion and catastrophic failure. The Bank of England pioneered fractional reserves, credit expansion, and centralized financial authority over national currencies. These mechanisms worked brilliantly during stability, but unleashed chaos whenever governments overspent significantly. Early crises revealed the dangers, including panics where the bank's credit system nearly collapsed entirely. Each failure exposed the same fatal flaw: a currency based on confidence collapses when trust finally evaporates. Other nations admired England's economic strength and quickly adopted similar central banking structures and policies. France, Germany, Japan, and eventually the United States built systems modeled after England's financial architecture. Debt-backed money, bond markets, and interest rate manipulation became the foundation of modern economic governance. This model fueled industrial growth, military expansion, and unprecedented international trade throughout the 19th century. Yet it also embedded structural vulnerabilities that reappear in every modern currency collapse, without exception. As governments relied increasingly on borrowing, central banks became their primary enablers and rescuers. Debt expanded faster than productivity, setting the stage for recurring monetary crises across continents. The blueprint's weakness emerges when governments require more funding than markets willingly provide them. Central banks then intervene, purchasing bonds and injecting newly created money into struggling financial systems. This money creation outpaces economic growth, gradually weakening purchasing power and destabilizing currency confidence. Once the public recognizes inflation accelerating, trust erodes, and a dangerous self-reinforcing cycle begins. Currency holders rush to spend or convert savings, pushing prices higher and confidence lower relentlessly. Every historical hyperinflation and major collapse has followed this predictable sequence of events repeatedly. Germany's 1923 crisis began exactly this way, with war debts overwhelming the government's financial capacity completely. The central bank printed money to survive, unintentionally triggering one of history's most dramatic hyperinflations. Argentina's repeated failures follow the same pattern: overspending, central bank intervention, and recurring collapse. Zimbabwe's destruction emerged from monetizing government debt until the currency became worthless entirely. Turkey, Lebanon, and Sri Lanka recently repeated the pattern under political instability and excessive borrowing. Though circumstances differ, the mechanism always matches the blueprint created centuries ago in London. The blueprint survives because leaders find it easier to borrow than reform economic fundamentals meaningfully. As long as borrowing continues, the cycle inevitably drives currencies toward instability and eventual crisis. Countries attempt reforms such as austerity, capital controls, or currency pegs, but results rarely succeed sustainably. Structural flaws remain because they originate within the monetary system's design, not temporary political missteps. Even dollarized nations struggle when underlying debts and confidence issues remain unresolved over time. IMF bailouts often delay collapse but seldom fix systemic vulnerabilities embedded in debt-backed currencies globally. Every attempted repair ignores the central issue: confidence cannot support infinite debt expansion indefinitely. And when confidence breaks, no policy can restore value quickly enough to prevent severe economic damage. Today the world faces debt levels unprecedented in recorded financial history, surpassing wartime extremes significantly. Governments borrow at extraordinary scale, and central banks intervene rapidly to stabilize fragile markets. The United States, Europe, Japan, and China all rely heavily on debt-based monetary expansion presently. Rising interest rates pressure governments, revealing dependence on central banks to avoid fiscal breakdown. The blueprint's flaw emerges again. When debts exceed capacity, central banks must create more money aggressively. This process weakens currencies worldwide and erodes public trust, similar to past collapses repeatedly. Inflation rises, savings lose value, and citizens increasingly question their government's ability to maintain stability. The same chain reaction witnessed historically is reappearing across major economies in real time currently. Bond markets grow unstable as investors demand higher returns for lending to heavily indebted governments. Central banks respond by buying bonds, mirroring the original Bank of England mechanism exactly. This creates fresh money and masks underlying weaknesses, but long-term consequences accumulate dangerously. Each intervention increases future instability, pushing currencies closer toward potential breaking points again. Modern currencies show symptoms identical to early warning signs preceding historical collapses worldwide. The blueprint's flaw is becoming harder to ignore as global systems reach unprecedented stress levels. Nations rely on financial engineering instead of addressing structural imbalances or reducing excessive debt responsibly. History shows such choices lead inevitably toward crisis, following pathways consistent with the original blueprint. The more governments rely on central bank assistance, the more fragile their currencies ultimately become. Trust erodes quietly before collapsing suddenly, as witnessed in every major monetary crisis previously. The Bank of England never intended to design a system prone to catastrophic failure inherently. Its blueprint emerged from wartime necessity and innovative problem-solving during desperate national circumstances. Yet repeating this model globally created a hidden architecture vulnerable to political misuse and excessive borrowing. Debt-based money works extraordinarily well during stable periods, but collapses violently when pressures intensify. Understanding this blueprint reveals why modern currency systems repeatedly suffer similar crises across decades. The pattern resurfaces because the underlying mechanics remain unchanged despite economic modernization globally. Governments still overspend, central banks still intervene, and confidence still evaporates under mounting pressure. All collapses follow these identical mechanisms, proving the blueprint's influence persists unchanged today. Recognizing this pattern provides insight into looming risks facing major economies worldwide right now. Rising debt, inflation, and instability reveal a system again approaching critical stress as history echoes. The blueprint's longevity ensures it influences every financial decision made by global policymakers currently. But its fragility warns that no currency remains stable once confidence in debt-backed structures fades. 3 takeaways stand out for understanding future economic dangers and potential monetary disruptions ahead. First, every major currency today relies on the same Bank of England blueprint entirely. Second, this system works only as long as governments avoid excessive borrowing that endangers confidence. Third, once trust breaks, currency collapse follows a predictable sequence, very difficult to stop effectively. These lessons explain why economic history repeats with surprising consistency across nations and centuries. A final warning emerges. The next global currency crisis will not be accidental or unpredictable. It will be the inevitable result of pushing a centuries-old system beyond sustainable limits entirely. Modern governments depend on this blueprint even as it strains beneath unprecedented financial pressures worldwide. Citizens must understand the architecture shaping their money before instability transforms into widespread collapse. Awareness is essential because early recognition offers the best chance of protecting personal financial security. The blueprint's strengths and flaws reveal a hidden system influencing everyone, regardless of national borders. With risks rising globally, understanding monetary mechanics becomes a critical line of defense for individuals. Examine history, observe present conditions, and prepare for future challenges shaped by this enduring blueprint. Its influence remains immense, but so does the vulnerability created by excessive reliance on debt. The system can survive pressures but not unlimited stress driven by political or economic recklessness. Now is the time to stay informed, question assumptions, and recognize repeating patterns across centuries. To explore more hidden financial frameworks and unfolding economic risks, subscribe and join future deep dives. Together, we can uncover the mechanisms shaping global stability and navigate the uncertainties of the coming era.